ago. That's CN Rail. What did you see, Andy?
It looks like a beat, a very, very slight beat. $1.72 adjusted EPS in their latest quarter, 1 cent ahead of expectations. Revenue slightly weaker. Profit did drop. It was $1.72, as I said, down from $1.82 in the same frame a year earlier. Revenue slightly weaker, $4.25 billion. The street was looking for something closer to $4.3 billion. But it looks as though these numbers from CN Rail in line. Now, the operating ratio did go up versus last year.
What is it?
Yeah, it is 63.6 versus 61.5%.
A little higher than expected.
Yeah. No, I'm not sure what the consensus was. I'm sorry.
63.4.
Oh, was it? I'm sorry. Okay. So certainly less efficient because you don't want that thing to go up.
No, I mean, these stocks couldn't be more different, right, in terms of maybe the shareholders,
right.
CN and Tesla. But it is kind of a bellwether of the economy, literally moves everything in the economy. Mark, how are you thinking about this one?
Yeah, I mean, they beat a little bit. I think looking at the charts here, there's a little more value in some of the U.S. names than in CNI, but a nice report came out a little bit ahead on earnings, and I'm going to guess that the reaction tomorrow is not going to be relatively muted, and it'll just kind of move along its business.
Let's bring in Ben Nolan.
Much like a slow-moving freight train.
Yes, that's what you, I guess, buy them for. Ben Nolan, who's an analyst with Stifel. Just to recap, earnings coming in slightly ahead of expectations. They've also given their outlook for 2024, essentially reaffirming that they expect 10% earnings growth. This is a quarter where earnings did fall, even though it came in line with expectations. So there were some hurdles to overcome here, Ben. What do you see as kind of the path forward here for CN Rail?
Yeah, that's right. And as you said, it was expected that this quarter was going to be a little bit softer, certainly than last year. And usually the first quarter is always a little bit challenging anyway, given weather. But they were facing some pretty difficult comps, particularly on the grain side of the business, where last year was especially good. And this year it was just going to be tough to beat that. The other big hurdle, as you guys mentioned earlier, is coal. Their coal volumes were down about 13%. That was largely U.S. related. This is part of their U.S. business. And unfortunately, that coal business tends to be very high margin. And so that's a little bit of the drag on the operating ratio that you talked about. But in general, I'd say this isn't too bad. There were some headwinds. We knew that those were going to be the case. And they still expect to be able to grow earnings by 10% this year.
Is that going to be satisfying to investors, reaffirming a forecast, or was there some hope that they boosted?
Yeah, and it's a good question. I think so. You have seen the shares reprice up a little bit and then give some back, but they're not way out of line with respect to valuation. And so I don't know that there was the street was anticipating a large beat or anything like that. So all they needed to do was just sort of deliver on what was expected, such that they don't have to revise down their earnings guidance. I would say, though, that the earnings guide is still pretty back-end weighted with respect to how you come to those numbers. So they're anticipating, as are really all their competitors, an acceleration into the back half of the year. So there is some risk to that materializing, but at least they're off to a decent start here.
You've got a hold on this one. Why aren't you more constructive? What do you like better?
It's really valuation for me. I mean, it's trading 400 basis points better, or 4 turns higher than CSX, for instance, on the U.S. side. It's higher than Union Pacific. I think they're in a good company, in a good position, but I'd like to own it a little cheaper.